Hey guys, what's up? So, look, a lot of people right now are talking about the Silicon Valley bank collapse, and I'm not usually one who's going to comment on headlines that are out there because there's enough of that, with the exception of today, because I've already seen a couple of influencers out there using this as a scare tactic to get people to buy their real estate deals or invest in their insurance deals. And so, what I wanted to do instead was just give you some education and a quick lesson about what happened and what can you do to protect yourself, and will you at all be impacted by what's going on at Silicon Valley. So let's just talk about Silicon Valley as a bank as it is. So they're located obviously up in Northern California. The vast majority of their clients are technology startup companies. And if you know anything about tech startup companies, they burn through a tremendous amount of cash. They are highly dependent on their ability to continue to raise cash. And what's happened with interest rates as of the last year, it's become very difficult to go out there and get cash for startups, especially if you're not a profitable company. And so what's been happening? Well, Silicon Valley, that's the vast majority of their customers. And as of late, a lot of cash has been getting pulled out. Just Thursday, they went and said, hey, we're going to try to raise some capital in the secondary markets. And when people heard about that, they started to hit the door. Let's talk about why. Well, they had about 175 billion, let's say, on deposit as of December of last year. 94% of that, so the vast majority of it, was not FDIC insured, meaning over the limits. What are the FDIC limits? $250,000 per depositor. So if you put in 250,000, if you want to put someone else like your wife or husband on your account, they could put 250,000. So max of 500,000. If you have a trust, that could be another 250,000. But the idea is when you get over 250,000 on deposit, there's no government insurance there to save the day. And so any of those dollars above and beyond that are at the risk of that financial institution. And so what's happened is as people have taken that money out, they started running out of money. It's called a run on the bank. And how does that happen? Well, a lot of people think if I put money into the bank, every dollar I put in stays there. Not the truth. There's something called tier one, or just basically what you need to know, leverage ratios, that the bank only has to keep about 10% of what's put on deposit. So if you give them $100, they really only have to have about $10 that's accessible to pay you back. Well, why? Because they're lending money and doing those types of things that banks are supposed to do. But what happens is when people get nervous, if everybody goes in and says, hey, give me all my money back at the same time, because they only have that 10%, they can run out of money. And so that's basically what happened. The FDIC came in on Friday and took control over the bank. And now what they're going to do, because it's in trust right now with the FDIC, they're going to look and see who gets paid out, who doesn't get paid out. A lot of people will more than likely, unfortunately, because of this collapse, lose their money. Roku, actually, big company, publicly traded company. You might want to take a look. Are you invested in it? They came out and said about 24% of their cash was actually at Silicon Valley Bank. And that's something we're about $300-400 million. Well, they're only secured for about 250K. So what does that mean? It means they could lose a lot of money. Not good for Roku, not good for shareholders of Roku. So when you look at this, 94% sounds crazy, but Citibank, about 74% of the money is unprotected there. First Republic, about 64%. If you look at Bank of America, about 50%. So it's not super uncommon, but what is super uncommon is this high concentration to one sector or one customer. So that's something you need to be aware of. But for most of you, look at your banks. Anything that you have per depositor over 250,000, understand that is not protected. For most of you, like a JP Morgan, those so diversified, you're not going to have to worry about anything. Citibank, Bank of America. But when you look at these smaller regional banks that are especially tied to just one sector, and probably the most volatile sector right now out there, you are susceptible. But if you're worried, even with the larger banks, just don't keep more than 250,000 per deposit. And you can go to Bank of America, you could go to Chase, you can go to Citibank. You can open at multiple banks, and each bank that you open, each depositor with cash is going to be protected up to 250 grand. So a lot of people, one of these influencers in particular, is telling you, hey, get it out, put it in hard assets, don't have cash. Well, you need to have cash. There's other things besides real estate that's going to lock your money up forever. There's short-term treasury bills that are paying 2.5%, 3% right now that you have full liquidity and access to. The government is not going to default. You're not going to lose your money. The point is, do not get scared into making decisions that are going to benefit other people and not yourself. Educate yourself. If you don't have over $250,000 in cash in any one account for any one depositor, you have nothing to worry about. If you are concerned, just transfer some of that to 2 or 3 other banks. You're going to be protected. But understand this, educate yourself. Don't let scare tactics, and they'll be coming out now trying to get you to buy gold, buy real estate, whatever it is that they can earn a fat commission on to take your money. And if you're uneducated, you'll be one of those people who fall for it. Don't let it be you. You know what's going on with Silicon Valley Bank now. You know how to protect yourself. Don't fall for any, scams out there. Talk to you later.